when we look at portfolios with clients or with friends, there's always some risks that are obvious, right? The risk of the stock market going down, volatility risk, things of that nature. Those are the things that I think the normal person associates with risk in a portfolio of stocks and bonds. Is it going to go up? Is it going to go down? How much is it going to go down? That's my risk, right? Well, that's true. Volatility is a risk. And we can certainly dive more into that, how it's risky, how to avoid that risk. But I think there's a little bit of a misconception of the fact that that's the only risk in a portfolio. There are all kinds of risks. I will highlight one of them, right, Adam? Having cash is risky sometimes. Sometimes. For some people, if you're in 100% cash, that's the riskiest thing you could do. I'm 30 years old. Cash is going to be a risky asset for me if I want to hold that until I'm 60. Now, if I'm 80 years old and I need to buy something tomorrow, cash is a good asset to own. So what we call that is, what's your inflation risk? And there's also things like concentration risk, right? These are all portfolio risks. Mm-hmm. What are some other portfolio or personal risks that you can think of?
Yeah, I mean, there's all kinds of personal risks, like disability, or maybe your income goes down a lot. There's something called longevity risk, which is kind of like a funny way for finance people to make a good thing sound bad, which is basically you live longer than you thought, which I think most people would celebrate, but it is a risk to have to draw on your assets longer than you think. And then there's risk where the personal intersects with the portfolio, right? Like, so volatility risk may be less relevant for somebody if they have a longer time horizon and can wait out shorter term spikes in volatility. Inflation risk may be less relevant if you have a shorter time horizon. Inflation can really eat away over 30 years, but over 1 or 2 years, inflation's probably not going to be as big of a deal. So it really depends. It's the interaction of the portfolio technical risks and the plan. And one analogy I always like to make is, volatility is, like you said, the one that people think about is like, how much is my portfolio going to bounce around? And that's kind of like turbulence in an airplane, right? Like it might bounce around. Well, if I told you, hey, there's going to be no turbulence on this flight, but we're headed right into the ground, does that seem low risk, right? Like, and that's kind of the inflation risk on the other end. Like, if you make a plan where, hey, I'm in all cash, mm-hmm. It's not going to move around a lot, but I know I'm going to run out of money. That's its own type of risk. So when we're talking about risk, there's kind of the conventional finance nerd terms, volatility, beta, all this kind of stuff that is helpful in helping us analyze it, but really it's those measures the rubber has to meet the road with what's your plan, and how do all these different types of risks, some that you pointed out, align with your specific goals and objectives, and because at the end of the day, it's like, the risk is that your portfolio doesn't enable the type of lifestyle that you want, and there's all different elements of that, as you know better than me.
Yep, absolutely. That's good. That's a great point. And that's a good way to define the overall risk of having or not having a plan, or not having a well thought out plan. And so that kind of gets into the other point that I always like to make with risk is behavioral risk. So volatility risk becomes a whole lot riskier if you're not able to stay in your seat, for lack of a better word, when the market goes down, right? As long as you're in good assets. And so there's other things with behavioral risk, but behavioral risks is just what it sounds. It's not acting rationally when you should. And so how do we manage all these risks? Or first, how do we identify them, right? And really, that's a big part of our job. It's sitting with people, and it's getting an appetite for what they can stomach with the volatility. It's getting an idea of their time horizon, like we always like to talk about. How long do they have to invest the money? Is it 2 years, or is it 20 years, or is it 100 years? Is it multi-generational? Mm-hmm. Those are all different scenarios. And so that's what we have to identify first. And while we're doing that, while we're identifying those risks, we are crafting the plan. And that's how we manage the risk. If we have a good plan, we can align their goals with the portfolio and manage each different type of risk to the level that's possible, right? There's always some unknown out there. The market could go down a little further than we think, and you make some tweaks here and there. But that's really managing risks and identifying within a portfolio. It's a lot of back and forth with clients, and then implementing a good portfolio to meet those goals, right?
Absolutely. Yeah, that sums it up.
Okay, so that's a little bit on risk, and I appreciate all of you watching. Thanks for coming back to these videos. We're always seeking feedback for new videos. So if you see anything or think about anything that you'd like to hear more on, feel free to just drop us an email, and we'd be glad to do that. Thanks a lot.